Welcome to chapter 10. It's a chapters about property plant equipment is the primary topic of the chapter. There's a few other little things too we'll talk about. It's always good to kind of just look at the learning objectives for every chapter. I'm not going to read them for you. You can read on your own and see what they are, but I just want you to see what they are so that gives you a handle of kind of what to expect as you begin to study the chapter. So the big topic, as I mentioned, property, plant, and equipment. But I want to make sure we set the table, talk about what this means. So other words used are plant assets or fixed assets. Obviously, they all mean the same thing. And it says they have three characteristics: held for use in operations and not investment. That's a big one. Have an expected life of more than 1 year, and it represents future economic benefit, and it must be a tangible asset, something you can look at, see, and touch. So those are what we're talking about. Obviously, there's many examples of what those are, right? We all know what they are: machinery, equipment, a vehicle, a building, office furniture. It all be examples of property, plant, and equipment. Um, Also, it's kind of we're going back a little bit to your accounting principles days when you learned about these things initially. And remember that we record them at their historical cost, what they cost us to acquire them. The reason we use that, it's a very objective number. We have some kind of a source document or receipt that we know proves what we paid to acquire something. So it's an easy number to prove. And so that's why we use that. Um, Also, keep in mind when we dispose of something, it can generate a realized gain or loss. Okay. So when we dispose of it, that's the only time that happens. And so we'll learn about depreciation or kind of remind ourselves about depreciation. The thing about intermediate is you're just drilling deeper into topics that you learned in your accounting principles class. So it's not necessarily new information. We're just going to look at it again and maybe look at it from a few different angles than you did in your principles class. But remember what depreciation is: it's allocating the cost of an asset over its useful life. You want to allocate cost to expense over the useful life of the asset. That's really the big thing we're looking at here. Okay. And we have to, on the balance sheet, report property, plant, and equipment at what they call book value, which is cost minus all depreciation taken. Okay, so just keep that in mind too. And it's possible this third bullet point right here mentions impairment. And it's possible if something's impaired, we have to write it down to a fair value. So it's possible that we know that there's some fair value that's significantly lower than the current book value, and maybe it's a permanent type of impairment. If that's the case, then we would write the asset down to be conservative and objective in our presentation of our financials. So just giving you an example here. It's coming right from your book. The same info is right in your book, just showing us the note for Verizon, their property, plant, equipment. You can imagine how much property, plant, equipment Verizon has. Huge company all across the country. We all know them here in where we live for cell phones, but they also have cable networks similar to like Midco, also, and a few other ventures too. So they're in quite a bit. So they do have a lot of property, plant, equipment. And this is just showing us some more information from the notes. And I should mention, all publicly owned companies, we have the main financial statements. We all know what those are: the income statement, statement of equity, balance sheet, and the cash flow. But then a publicly owned company has to issue all kinds of notes that go with the financials. And those notes are explaining each line item of the financials in great detail. So obviously on the balance sheet, we would have a line for property, plant, and equipment. And then there's a note to the financials that explains all the details about what goes into that one number. So on the balance sheet, we'll have, right here are the numbers right here. This is in millions, which means this is, $88 million worth of property, plant, and equipment. And you can see it's broken out into these categories with useful lives, less depreciation, and so on. So you can kind of just see the dollar amount of property, plant, equipment that Verizon has for a couple of years. Okay, and I'll let you read those questions and answer those on your own. You can definitely just, read that. You can read the PowerPoint slides. So I'll just let you read those on your own. And then how do we account for the acquisition of property, plant, and equipment? So again, remember, this is going back to a few of the things that you learned back in accounting principles. We want to remind ourselves, um, and it says here, it says major type of assets included in this category are land, building equipment, and leasehold improvements. And the leasehold improvement is if you're leasing a property, but you pay to have it improved or laid out the way you want. So, like if you are leasing a store at a strip mall, you probably will have to spend some amount of money to get that empty spot or whatever, however it's configured, reconfigured to the layout that you want. That's a leasehold improvement. So you're going to, basically do a remodel or a construction within this building you're leasing and get it ready for its intended use as a store or whatever it would be. So acquisition cost includes not only the cost of purchasing an asset. You might go to your, a great example to me is a delivery van. If you go down to, let's say Billion Automotive, and you go to them and you buy a new delivery van, you negotiate a price, right? And then they're going to give you paperwork that says, here's the agreed upon price. You're going to sign a few documents. Here's the price. Here's what you owe us for this vehicle. Well, we know that the cost doesn't end there, right? If I'm buying a delivery van, I'm probably also going to maybe put some signage on it. So I might go to another store in town and get some signage for my delivery van. For sure, I'll have to go pay for the sales tax on that van. That'll be 3% of the sales price, and so on. So those are the kinds of things I have to, take into account that include capitalization. But they also include, depending on what the asset is, it might be a cost of freight, assembly, installation, testing, and a retirement obligation. So those are all things that could go into it. One thing about land is the only asset that we do not depreciate. We depreciate every other asset. We do depreciate things like land improvements, like a parking lot and landscaping, because those things don't last forever. At some point, they need repair and replacement and so on. So land is the only one that does not depreciate, but there's a whole lot of things that go into what goes into the cost of land. So just make sure you've got to look at those. You guys can look at those or right from your chapter two. And this just gives us an example of buying land and the costs that go into getting the land ready for use. Maybe it's knocking down an old building there. If you ever bought a home, you kind of go through that process when you buy a house of you negotiate a price, right, for that home from whoever's selling it to you, but then when you go to close, you're paying all kinds of little fees and costs, right? And that's what this is showing us. You can see here that we're catching up a whole bunch of stuff. And so here's my journal entry to debit land. We had a little bit of property tax expense right there. This $800 right here. The delinquent went into the cost of the land, but the current is just expense. And then we credit cash for the net amount that we paid. So good example of a journal entry to buy land. You'll definitely have those in your homework for the week. I did mention land improvements a little bit in buildings. A building will last a really long time. Land improvements will last a really long time, but they don't last forever. And at some point in time, they will need updates and repairs, right? It's just the nature of it. Something sitting outside, uh, nature comes into play, and things just need repair and improvement over time. So we still do depreciate land improvements and buildings because of that. And equipment is a very broad category. Lots of types of things fit into equipment, obviously. But generally, we're looking at the purchase price, sales taxes paid, transportation, insurance upon delivery while it's in transit. You have to pay a little extra insurance maybe while something's in semi getting delivered to your place of business. Installation, assembly, testing. It's just really think of equipment as all the costs that go into getting that piece of equipment actually ready to use. So the testing, some training also. So just whatever it costs to get it ready to use for whatever its intended purpose is what we're looking for. And then here's just an example right here of a great example of a journal entry for purchasing equipment. And this is where you have to really pay attention. And sometimes you have to figure out, okay, if I don't debit asset, I have to debit expense, right? I know my cost is 111,000, but you can see there's actually a $500 debit to expense, and that was for some uninsured damage. So you ever have to kind of pay attention to some things like that in your questions about how to classify certain of those. And I mentioned what a leaseholder improvement is, and and we have to look for with leaseholder improvements. It says economic life or the life of the lease, whichever is shorter, and probably the life of the lease is shorter. So we got to be careful about that too. So with leasehold improvements, it's not the life of the asset; it's probably the length of the lease that's going to drive the years that we use to depreciate over. Okay. Um, and so, this is a big deal. This directly affects financial statements, the amount of depreciation taken, the amount that we capitalize. And when I say the word capitalize, that means we're debiting asset. So if I capitalize something, I debit asset. And once I debit asset, I turn that asset into expense by depreciating over its life. Okay, and then just some various ratios we can look at to help us measure or understand property, plant, and equipment. Now, keep in mind with ratios, they're a great way to compare, but also keep in mind, I guess what I'll call apples to oranges with comparisons. If I'm comparing a manufacturing company against a retailer, a manufacturer will use a lot more property, plant, and equipment than a retailer would. Or if I'm even comparing a more of a bricks and mortar retailer like a grocery store against Amazon, which is more of an internet retailer, Amazon would probably have less property, plant, equipment type ratios. Their numbers be lower than a brick and mortar retailer. So I always have to keep that in mind. And when you're comparing companies against each other. You got to keep in mind, why those numbers might be different. Now, within the same industry, hopefully we do find comparables, right? If I'm looking at Target's property, plant, and equipment ratios, I probably can make the leap that I should be able to compare those to a Walmart, probably their main competitor, So I can look at things from that perspective and go, okay, that should make sense. So, but just ratios are a comparison. And remember that we're comparing our own company's history over time. We can compare to key competitors in our industry, or we could even compare to an industry average. So the net fixed asset turnover is just telling me how much in sales do I generate with the assets that I have. So how good am I at taking the property, plant, equipment assets that I have and turning those into sales. Now, some assets require some kind of a retirement obligation. Think of anything that's probably environmental. If you're going to build a nuclear power plant, there's a really good chance that whatever that regulatory agency is that's overseeing that will require that you put some money on deposit in a bank account, in a trust account that you can't touch. And that money will be used to decommission the plant whenever it's time for that plant's useful life to end. If it's a strip mining, or anything like that, where you're maybe tearing the ground apart, but the regulatory approval before you get your permit says you have to put it all back together again. And the government's saying, but that's your cost, not ours. So you need to put money aside, put it in a trust account that you can't touch anymore. And that'll get used then when you're done mining this land, that you can then put the land back together again. And it can be used for whatever the next use may be. So that is what they call an asset retirement obligation. And it says here we carry that as a liability with an offsetting increase in the carrying value of the related asset. So you have a few questions about this in your homework very clearly. And the example they're giving us is about leaseholder improvements. And there's an asset retirement obligation at this one also. Probably what they're saying is, when at some point in time, we'll have to redesign the store. Think about how often some retailers redesign their stores. Sometimes it's like it just drives you crazy how often they do it. But they do that because, as consumers, if you go to a store that kind of looks old and outdated, you may not come back, you know. So I think retailers are very aware there has to be a certain look and feel to their stores. It kind of has to keep up with the times and look modern and fresh and so on. So I want you to be aware of the word accretion. Accretion expense classifies an operating expense, represents the increase of the asset retirement obligation each year that the asset is used. Okay, so just be aware of accretion. Lump sum purchases. Sometimes when you buy an asset, you're buying a bundle of assets. You're for one price, you're buying building and land. For one price, you're buying building, land, and equipment. I worked at a company in Sioux Falls where we built a brand new home office. We were downtown. We built a brand new home office on the edge of town. And when we built the brand new home office, the decision was made, let's just completely refurbish or for furniture, use everything brand new. So literally everything was new. New computers, new um, cubicles, desks, chairs, everything was brand new. The thought was, let's just start fresh. And so when we sold the old building, it literally included everything that we left behind. So it was land, it was building, and a whole lot of office furniture and equipment and stuff that we just didn't want anymore. And it was very known to whoever's going to buy it, you're getting it all. Okay, it's a lump sum purchase. And when you buy this, you get it all. Then you decide what you want to do with the stuff you don't want, you know, auction it off or give it away or whatever. So it's not uncommon. That kind of thing does happen. And it's really an allocation. And a great example here is if you buy a building, well, you're also typically buying the land that building is on. And remember why it's important to separate the value of land from the value of building. It's that we don't depreciate land, but we do depreciate buildings. So it is important that we have a split that makes sense. So you will have a few questions that'll deal with this, or something similar to this. And it says here an appraisal of land and building indicates values of 50,000 and 75,000. So, an independent appraisal said one's worth 50, one's worth 75. We paid 120 for them both together. And so we just do an allocation based on that value. 50 plus 75 is the 125. And we basically then say land's worth 48 on our balance sheet and building's worth 72 on our balance sheet. And then we, of course, depreciate the building, but we do not depreciate the land. Okay. Also, it's possible that when you buy something really expensive, like property, plant, and equipment, a building, land, expensive equipment, it's possible that you're paying for that not with cash, but by doing some sort of financing. And maybe you're issuing bonds, issuing notes, assuming a mortgage, something like that, in order to be able to afford and pay for the expensive item. Okay, so just kind of be aware of that. So, and it's very common then that you would debit some kind of an asset and credit some kind of a payable, like a note payable, bond payable, mortgage payable, whatever it might be. It's a very typical and common type of entry. And then also in accounting principles, I'm sure you learned a little bit about interest, and especially when it comes to notes. In GAAP, there's really no such thing as a non-interest bearing note. So, I mean, those exist, but in GAAP, you always have to record interest. Okay, so it says here for this example, Antush Company purchase equipment by issuing a $10,000 non-interest bearing 5-year note. The market rate for obligations like this is 12%. The note will be paid off at the rate of 2,000 at the end of each year. And so for once a year for 5 years, they'll pay $2,000 off on this note. However, there's always interest. So we're just kind of keeping that in mind. We have to go through the process of computing the present value of the payments. And when you get a question like this in Cengage, it should hopefully pop up a little box that shows you what the factors are. So you can apply the present value factors. So basically what we're saying is the present value of an annuity for 5 years at 12% is this factor right here. So 2,000 times that factor, then is the 7,210, and that's what we'll value the equipment at. We have a payable for 10,000, but then we have a discount on what's payable that will then amortize and turn that into interest expense over the next 5 years. So just be very aware that you'll deal with a few questions like that. And then sometimes, of course, you might just issue stock or preferred stock, common stock or preferred stock, in exchange for purchasing an asset too. And there's certain rules about that. And in GAAP, there's what we call fair value rules, and we'll get into fair value rules deeper on in the chapter, in other chapters as we go through the book. There's what they call different levels of fair value measurement. We just really haven't necessarily gotten there yet to fully explain that. It kind of just talks about here, it says normally the two fair value measures would be very similar. And we're talking the fair value of the asset, the property, plant, and equipment, and the fair value of the stock issued. And it says here that we should use whichever one is more clearly evident, or what they call representationally faithful. Basically, what really does represent the intent of the parties. Whoops, I didn't mean to bump my mouse when they bought these securities. So sometimes it's a judgment call. Sometimes in GAAP you have to make the best judgment you can with the information that you have, and they're kind of saying that might come into play, but generally somebody who's selling you property, plant, and equipment, they know what it's worth, but they may be willing to accept less than what it's worth if they think your stock is a really good stock, right? And they believe your stock might go up in value. So we have to kind of measure the two and look at them and make a decision. So they kind of talk about level three input in the FASB's fair value hierarchy is that faithful representation discussion. And that's probably what makes intermediate just a little bit different than accounting principles is we kind of live a little bit more in the gray areas where we have to make judgment calls. When you were presented your homework assignments in principles, I think for the vast majority of assignments we give you in principles, it's this or it's this. I mean, there's not a lot of gray area with judgment in between, but in intermediate, we want to be aware of that kind of those grayer areas where you might have to make a judgment call. So here's an example. This is issuing stock in exchange for land, and these things do happen. Kind of keep in mind when corporations first start out, they may not have a lot of cash, or maybe it's a sole proprietorship or a partnership that's gotten a little bit bigger, and they want to incorporate as a means to be able to sell shares and raise funds for future growth. But it's possible in that situation that this business, becoming incorporated is maybe cash poor, but stock rich, right? So if they can convince somebody, hey, instead of writing you a check for $150,000 for this land, what if I gave you some shares of stock, and then our company should go up in value, and you're going to be better off than just receiving cash from us. So those types of transactions do happen. So so if we can convince somebody to sell us some land in exchange for stock, we can certainly do that. And it says here, the fair value of the stock was 15. We issued 10,000 shares in exchange for the land. So you can kind of see we valued the land based on the shares times the 15 per share to get the 150 and so on. So that's obviously one way to go ahead and do that. It's possible that you can have something donated to you also. And if you do, that's just simply a gain. Some municipalities will give a business land in exchange for building a building and hiring people, right? I mean, that does happen. There are, especially a lot of small towns may have what they call an industrial park. It's owned by the city, the county, whoever it is, and they're looking for businesses to build in these industrial parks. And quite often they may just give you land in exchange for, obviously there's certain promises that are, contracts signed and promises made, but they may donate the land in exchange for a promise to build a building, hire people, attract new people to live in our community, pay taxes, da 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 da. So it happens more often than you might think. Obviously, a nonprofit would be receiving donations all the time. Okay. And then how do we account for non-monetary exchanges? And this gets a little complicated. We have to kind of think, okay, we're swapping assets or we're trading an asset for a service. It can be a little bit more challenging. Quite possible that we're going to incur some kind of a gain or loss in that exchange also. Okay. So this is a general rule of thumb. So this is slide 32. This is probably one you'll want to refer back to when you do some of these homework assignments. Um, and then keep in mind the term boot right here. So a small amount of cash is referred to as the boot. When that's given or received, the cost of the asset acquired and the gain and loss of non-monetary assets surrenders determined by these equations. Okay, so you're really trying to figure out what's the value I'm giving up compared to the value that I'm receiving. Okay, value given up versus value receiving. If you kind of just think this big picture, that's what I'm trying to accomplish. That should help a little bit. And they're giving us some examples right here. Now, in this particular example, this is a no cash exchange. Arnold entered an agreement with Carbon to exchange one of its small buildings for a specialized piece of equipment that is owned by Carbon. And then you can kind of just see how the two different properties here and how they went about and valued that. And you can see there's fair values surrendered by each company, different book values, and so on. But you can see how that turned into two different journal entries for each one. One acquired one asset and gave up another. And so you always have to compare the value of what you're receiving against the fair value of what you're receiving against the book value you gave up to get that. And that difference is a gain or a loss. In this example, Arnold had a loss and Carbon had a gain. So I'll let you look at that on your own, but that's just the general rule of thumb is compare the value that you're receiving against the book value giving up to get that, and that'll probably kick in for the vast majority of your problems some kind of a gain or loss. Now, if I throw cash in there, now that's that boot thing, right? A small amount of cash here is the boot. That does change things just a little bit. Okay, so what I want you to recognize by comparing these journal entries is you can see here, this is no cash changed hands. Then we jump down to this one, and some cash changed hands. And so, that changes the entries just a little bit. And I just want you to be aware of that. So just really watch those. You can see for Arnold on the left-hand side, they incurred a loss of 6,000 with no cash. Well, when they include the 5,000 cash, there's still no loss. Okay, but for Carbon, when they did this no cash trade, they had a gain of 12,000. When they threw in cash, though, that gain went down to 7,000. Okay, so just kind of keep that in mind because they're paying cash. They give up cash and Arnold received it. So depending on how you're looking at this, that cash boot may impact the gain or loss received if you're the giver or the receiver of that cash. Okay, so just keep in mind about that. Those are just kind of some common rules to think through. And then, as long as we're still talking about non-monetary exchanges, it says there's an exception to the general rule to use fair value for non-monetary exchanges. And I think the biggest thing here is that this middle slide right here, when the company's future cash flows are expected to significantly change as a result of the exchange, it has commercial substance. So if this exchange will change my cash flows significantly, then it has commercial substance. If an exchange does not have commercial substance and results in a loss, the general rule discussed earlier is followed. If the exchange does not have commercial substance and results in a gain, GAAP requires the gain to be deferred by reducing the cost of the asset. So just kind of keep in mind when you're doing some homework problems, is there commercial substance to this? And they're going to have to tell you, it's a judgment call. They'll have to tell you that. So don't worry about trying to figure it out. Know what the term commercial substance means, but in the homework problems, they have to tell you if that's the case or not. Otherwise, we would never know. We don't, they're just giving us these little snippets. But in real life, if I was at a business, I'd hopefully have the history, the background, the knowledge to go, hey, this is a commercial substance or this is not. So uh, there's another example right there. I'll just let you guys take a look at that on your own. And these all these examples are coming right from your textbook too. So they're available in the PowerPoints or your book either way. Okay, so I'm going to stop right there, just kind of just to break this out into two chunks. So I'll stop right there and we'll do another one for chapter